What's going on, guys? Welcome back to the channel. My name is Matt, and TD has actually recently released their earnings, and something that has come out that they've released is something really interesting to me and something I want to talk about today. Over 80% of TD's mortgages are going to renew over the next 3 years. Okay, 80%. Okay, so their second quarter filings show that $309 billion worth of the bank's mortgage portfolio will be renewing in the next 3 years. Roughly 82% of the bank's total amortizing balances. Huge amount of mortgages are going to be coming up for renewal. That includes roughly $224 billion worth of fixed rate mortgages and $86 billion of variable rate mortgages. So you can see just how much of that is fixed rate mortgages, okay? $224 billion. And what I'll do is I'll post this maturity schedule chart that I'm currently looking at, which effectively shows each fiscal year and the percentages of each variable rate and fixed rate balance. So you can really see in 26, that's the highest year where the most fixed year and variable has more coming up in 27. But you can see in fiscal year 25 and 26, that is when a lot of mortgages are going to be renewed, okay, specifically with TD. And across all federally related financial institutions, 76% of outstanding mortgages are expected to come up for renewal at the end of 2026. Okay, so over the next couple of years, we're going to see so many mortgages coming up for renewal, and it's going to be really an important thing to watch. Okay, so Canada's banking regulator, OSFI, okay, has warned that the upcoming waves of renewals across all mortgage lenders pose significant risk to Canada's financial system. This is like a big deal. This isn't a small thing to look at, right? These mortgages coming up for renewal pose a significant risk for the entire financial system, not just one part of it, the whole thing. And while this risk remains, the impact of payment shock, again, may be mitigated by these interest rate cuts that we're expected to see over the next year and a half, right? But again, that doesn't mean for sure that payment shock won't be as bad. Payment shock will definitely be bad for people. It's just a matter of how bad is it going to be for the majority of people, okay? And TD is one of Canada's biggest banks that offers fixed payment variable rate mortgages, which means that when rates change, they have variable products that the payment doesn't change, but what happens is more of that money goes to interest and less to principal, right? In a recent earnings call, Chief Risk Officer noted that many borrowers have taken proactive steps when approaching their trigger rate. So what happens is the bank will let you know that you've hit your trigger rate or you're approaching your trigger rate. And what happens is clients can respond by making lump sum payments. They can switch to a fixed rate mortgage, or they can increase their principal and interest payments. Okay, so they can do a few different things. And TD has noted in their earnings that clients have been approaching these things properly, right? And they're trying to mitigate these things. So that is a good sign that people, even though they're hitting their trigger rate, okay, they're like increasing their payments, right? They don't want to just pay only interest. They want to get some principal paid down, which is good. And consequently, TD has seen its mortgage amortization period normalize. 15.4% of the portfolio has an amortization of 35 years or more, down from 27.4% in Q1 of 2023. So also post this chart which says the remaining amortizations for the TD residential mortgages. So you can see pretty much Q3, Q2, and Q3, right? So we see here remaining amortizations between 25 and 30 years have actually gone up. So each quarter, remaining amortizations are going up, and you can see 30 to 35 actually went down, but then went up again, and 35 years or more went down, which is good. But you can see here 20 to 25 years has gone up as well. And then 15 to 20 years has gone up as well. So it seems that amortizations from 15 to 30 years have gone up quarter over quarter, meaning that possibly people are re-amortizing their mortgages higher to get lower payments. But in a way, it's like they're kicking the can down the road, and they're making it so that, okay, maybe they had 20 years, they're pushing that back up to 30 so they can have a cheaper payment, but then they have to have a 30-year mortgage again. So these aren't exactly good signs, right? When people are amortizing higher for lower payments, right? Typically to save on cash flow, right? But again, this is a method people can use to have a lower payment in the now, here and now, okay? And then we also have TD earnings highlights. And we're not going to go over all that because typically it says that their secured lending volumes were up 6% year over year, net margin. So the financial stuff has been good. The main thing I really wanted to talk about in this video was that 80% of their mortgages are going to be renewing in the next 3 years, okay? And what is going to happen in Canada specifically, right? Now, OSFI has warned them that this wave of renewals could cause catastrophe in the financial system. So we have to keep up to date and see what happens with that. Hope you guys enjoyed this video, a bit of a short one. Just wanted to touch on that with some charts. If you guys like the video, please hit like. Helps me push this video to a new audience who might really need to see this information. Of course, if you guys have any questions, let me know, and I'll see you guys in the next video. Take care.